Hi, everyone, and a warm welcome to this session on IDC FutureScapes. As you may know, IDC does this exercise every year, and this is our version of a crystal ball glazing exercise where all our analysts are coming together and are identifying the 10 most impactful banks for our specific sector, in this case, for European banking. And without much further ado, I wanted to start. Let me briefly introduce myself. My name is Tom Zink. I'm a research director for IDC Financial Insights. And you've probably seen me before in some of these Portuguese events. It's always a great pleasure to be here. And hopefully next time we can do this in presence again. So let me jump straight into our 10 most impactful trends in 2022 and beyond. So let me start by reading out those 10 predictions, and then I'll go through in a bit more detail across some of those predictions. Credible fintech. By 2022, consolidation of the fintech market will continue with at least 30% of prominent fintechs being acquired and another 30% failing because of their lack of scale. Prediction 2, buy now, pay later. By 2023, 65% of consumers across all channels will try an instant finance option. Prediction number 3, AI shapes the banking experience. By 2023, 25% of global banks will use AI-based sentiment analysis to improve customer experience on current and future products and services. Prediction number 4, relevant and responsible personalization. By 2024, 30% of global banks will use relevant and responsible personalization as a key differentiation weapon to create loyal clients. Prediction number 5, AML for good. As regulatory and social pressures increase, by 2024, 40% of banks will implement AI-based anti-money laundering models to better detect patterns of human trafficking and other illicit activity with high social impact. Prediction number 6, real-time payments. 50% of banks will build an overlay services portfolio by 2024, leveraging real-time payments, led by request to pay, conditional payments, and reconciliation services. Prediction number 7, analytics in the cloud. By 2025, 25% of Tier 1 banks globally will deploy their data warehouses and analytics operations in the cloud. Prediction number 8, trade finance. By 2025, the massive change brought by current and upcoming SWIFT releases will force legacy replacement, leading to 75% of trade finance systems being cloud-based. Prediction number 9, preventive insurance. By 2025, 50% of insurers will offer real-time risk prevention as a service to their retail customers in both live and non-live, either directly or through digital partnership ecosystems. And the last prediction, AI in payments. By 2026, 35% of payments will be optimized using AI-derived routing models. Now, obviously, this is a lot to go through, and there's quite a lot of impact in these predictions. To make that a little bit more visible, we have come up with this matrix, which is modeling the prediction and the timing until this prediction will reach mass adoption on the horizontal axis, and on the vertical axis, the cost and complexity to address that trend. And as you can see, there is quite a wide field. So some of the solutions are coming sooner than later, and others will have a much bigger impact on the banking sector than others. And particularly the ones in the right top corner are obviously the ones that need to be addressed because they both have this high complexity which will take time to really embrace, but they also have really a big impact on the overall business, and therefore it's never too early to start planning for those kind of trends. We only have a couple of minutes time, so I wanted to take these four predictions and look at them in a bit more detail. So let me take those one by one. Again, by 2023, 65 consumers across all channels will try an instant finance option. So this is a really interesting one because I think we are about to have another disruptive element or moment in payments. And we see this really starting off extremely strong in the US at the moment, where buy now, pay later has gained massive momentum. And we expect Europe to really follow that momentum, particularly as banks are still looking for applications for the new real-time payments infrastructures. And ultimately, this will mean real-time payments are not just coming to e-commerce transactions, but it will increasingly also move towards physical payments at the point of sale. And we really need to think about how we can create a seamless experience that allows customers to, source for credit quickly at the moment there's emotional momentum for them, so that the bank offer is, or the credit offer is relevant, yet still manage the potential risk that comes from these ultra-fast decisions. And I think that is a bit the challenge that a lot of organizations are still facing. It's taking them too long to make those decisions. They actually need to happen in almost real time. And the other big elephant in the room, and I think that is something that we probably will see in Europe to a higher degree once these are gaining momentum, is that regulators will ask for the explainability of those credit decisions. And then there will also be a strong focus to avoid that there is a surge in consumer debt following those new buy now, pay later initiatives. As for the IT impact, obviously it requires instant decisions that require scalable processes and relevant data. The customer service infrastructure also needs to adapt because there will be a lot more interaction coming from customers. And we recommend really to look at buy now, pay later at the point of sale to really look at the integration of that geolocation element. So to really mend out some of the security elements of it as well. So as for guidance, consider fintech partners who have already built solution in this space. You don't need to develop that for yourself. That will help you with time to market and also reduce the overall risk exposure. Be aware of regulatory scrutiny and potentially countermeasures if there is too strong go. And most importantly, I really believe that this is a new way to source for credit. So this will require a great degree of customer education as well as merchant education to really bring this to a success. Moving on to the next prediction. By 2023, 25% of global banks will use AI-based sentiment analysis to improve customer experience on current and future products and services. So ultimately, the message here is really banks will want to get closer to their customers and really build a better understanding of the customers' moods, but also where they are and what they really need. And sentiment analysis will really be used across digital channels, although that's where it will start. And then move on to assisted channels, particularly in the call center. There's a lot of potential, but ultimately it will really go across all digital and assisted channels to really help improve customer experience and loyalty. Obviously, this is a new technology. It requires the integration of video, text, and natural language processing to really detect those human emotions. We need to get better at contextual analytics as well to really build a constantly and solid, constantly reviewed data governance framework that can be also changed and adapted to the needs. And the algorithms to make this work are also need to be reviewed constantly for bias, for compliance, and also for their appropriateness. So as for guidance, we really recommend develop a data governance framework early with a focus on enabling real-time transactions. Bring in data security and privacy experts early, because this is something that you will need to resolve in order to make that work for you and also to avoid it getting creepy. And then Start with some of the simpler things like chatbots, like virtual agents, before you really progress to video analytics and integrate that analysis into live person-to-person interactions. Moving on to the next one, by 2025, 25% of tier 1 banks globally will deploy their data warehouses and analytics operations in the cloud. So clearly, all of us have seen that in the last 2 years. Cloud is the new the standard go-to model. Now, obviously, every country is still a bit different, but COVID has been a major catalyst for cloud deployments across Europe in the last 2 years. Particularly use cases around analytics and artificial applications are the key drivers, but also data warehousing, which traditionally remained more on-premise, is now moving to the cloud, although very often to a private cloud. I think a lot of companies have invested in data lake technology to also see through some of that more unstructured data. These have very early moved into the cloud. The key obstacles with this entire journey is really around regulatory requirements. And I think there's still a lot of stuff that needs to be discussed with the regulators and to really solved as well. Because at the moment, we do a lot of things simply because the regulator is asking, and they do not really make sense. And I think a great example for that is, for instance, data encryption. Do we really need to encrypt everything 3 times in order to make it safe, or do we really need to encrypt the metadata? So I think these are some of the questions that we still need to resolve to really make it more tangible to move workloads and also data to the cloud. As for the IT impact, security remains a moving target, and there is simply no 100% security, not in the cloud, not on premise. So we should no longer go after this goal. I mean, our job is to really make it as secure as possible while enabling a good usability. And I think this is really what we need to go after. Again, data governance is key to identify, classify, and locate different types of data wherever it makes sense. And I think while a lot of organizations are still kind of struggling with the security implementations, a lot of CIOs have understood that, particularly the hyperscalers, are spending so much more on security that it's extremely difficult for attackers to penetrate or to really succeed in hacking those infrastructures. But on the other hand, there is obviously a massive opportunity for them. So the first guy who's cracking any of the hyperscaler infrastructures will become very, very rich very quickly, because you're not just hacking one organization, you're hacking hundreds potentially. As for guidance, keep a constant conversation with your regulators on what makes sense and not. Monitor the cost implications of cloud closely and over time, because the contracts are changing, and very often cloud providers are baiting banks to move stuff to the cloud. It's a great deal for the first 3 years, but then the usual business conditions apply, and suddenly it can get very, very costly. So keep reviewing what you are putting into the cloud and for what reasons you're putting it there. And lastly, identify components of data that are candidates for deployment in the cloud based on factors such as cost, low latency, and risk. So I think this is a natural consideration everybody's going through when they move workloads to the cloud. So let me end with a last prediction. By 2025, the massive change brought about by current and upcoming Swift releases will force legacy replacement, leading to 75% of trade finance systems being cloud-based. Now, all of you who have been in corporate banking or in payments, you all have seen that the latest wave of Swift releases starting in 2018 have become a lot more cumbersome and a lot more difficult to address, because they are fundamentally changing the way they go about it, and they are migrating to the next infrastructure or to the next standards as well. So IC 20002 is coming. And what we really see is that a lot of the legacy systems, particularly those that had customizations or that were not updated regularly, are really, banks are struggling to modernize and to update this and implement the Swift releases on those legacy infrastructures. And for that reason, and as the change agenda from Swift is continuing, we believe that this will be one of the key drivers for organizations to eventually move off those legacy systems and move towards the latest version, optimally something that's run in the cloud. And then the second big change that we see happening is that organizations finally, after years and years of heavy customizations, are moving away from that. Because this is really the biggest pain in the back that you can go through as an organization if you have to really manually change the source code because of all your customization. I mean, it's great business for system integrators and consultancies, but it's very expensive if you want to do it. The benefits of it are somewhat, at least, well, something to be considered. So, as for IT impact, clearly, ISO 22002 will be a massive change, and it's not just affecting your trade finance system or all your payment systems. It goes further than that, because you also need to upgrade your master data management system, given that you store more amounts of or big amounts of data within those identifiers. And I think this is really going to be a sea change, and it is the time to move off those legacy systems. As for guidance, again, avoid customizations. Second, really opt for a flexible, adaptable, and functionally rich trade finance solution that's designed and developed as a global package. And also look for a provider that has committed to maintain and support one global source code across all their implementations. And third, really make sure that your vendor is automatically upgrading the system you're buying to the latest Swift releases, and that this is really happening automatically and is not something that you'll be charged for extra, or that's additional value. With that, I hold my peace. I wish you a great event today. It was a great pleasure to be here. And with that, if you have any questions on those predictions, let me know. If you want to talk about some of the others, give me a shout. It was a great pleasure to be here. Bye-bye.